thank you for joining MarshBerry for today's ViewPoint. I'm George Bucur, Director at MarshBerry. Today I'm here with Jeremiah Bickham, Global Treasurer and Head of Corporate Development at Ryan Specialty Group. Jeremiah played a critical role in many of Ryan Specialty Group's acquisitions, but most notably, we're here to talk to him today about the recent acquisitions of All Risks. Jeremiah, it's great to have you here today.
George, it's great to be with you virtually.
Virtually it is in today's day and age. So Jeremiah, we appreciate you taking a few minutes to go through and allow us to address some questions with you. I guess to start, can you provide some insight into what drove RSG's specific strategic decision to acquire All Risks and what led us to getting that transaction completed?
Yep, happy to. Before I go into All Risks specifically, it's important. You and the MarshBerry team have known us long enough that you guys understand this, but for this audience, important to clarify, we don't ever do deals strictly for scale. We've been able to sustain double-digit organic growth throughout almost our entire history. So we don't have to buy growth. And in today's market, that's really fortunate because it would be quite expensive if you had to do that. So instead, our acquisition strategy is underpinned in acquiring and adding differentiated products, expanding geography, and adding new underwriting expertise to the family. Because for us, it's there are some benefits of scale, but what we're really looking to achieve when we acquire is just to become more differentiated and more valuable to our clients. We've joked internally that we have, in a way, less of an acquisition strategy per se as a holistic organic growth strategy. When you can be more complete, when you have more to offer, when you can say, the more often you can say yes to our clients and capital providers, that's how you foster, how you accelerate and amplify organic growth opportunities. So that's the end game. And All Risk was no different. So let's just take a look at how that deal checks some of those boxes. So again, having known us for many years and worked with us on several transactions, MarshBerry is probably aware, we've been on a binding authority tear in terms of our M&A over the last, call it 3 or 4 years. We're very deep across products and geography on the pure transactional wholesale side of things, but on the binding authority side, which, as you know, is low limit, lower premium, some delegated authority, but it's more restricted than what you would consider a classic MGU. We've historically, up until All Risk, I should say, had less depth, less coverage than we wanted. There were still a lot of places in the map that we needed to fill in. All Risk provides that. They also have what I would consider, what I think a lot of market participants would consider an industry-leading innovative programs division that they've they've completely grown from scratch, actually. And that programs division is something that doesn't exist in the exact same form at RSG. So we've got binding authority, wholesale brokerage, and then we have the pure delegated authority of our MGUs and MGAs. And from our perspective, program sort of fits in between binding authority and MGUs on the underwriting spectrum. So that's a differentiated feature of this deal. They also traditionally, All Risk that is, have very, very deep relationships with regional retail agents. We sometimes call them tier 2 or tier 3, just because in the vernacular, tier 1 is often classified as like the top 50 or the top 100. And historically, our strongest relationships, a lot of our growth has been outsized towards like the large national retail brokers. So there's actually not that much overlap between our customers. They're more complementary. So that's a huge plus for us in this deal. Also, and like I said, it all comes down to organic growth, and their organic growth trajectory is they're the first company that I've encountered, and I've been at RSG for almost 10 years, been involved in M&A the whole time. They're the first company I've seen that's had as good or better organic growth year in and year out. They got to the size that they are with doing, 2 or 3 small acquisitions, but for almost their entire history, they've grown low to high teens. And part of how they've been able to accomplish that is a large focus, a large investment on training and recruitment. So they have this awesome program called All Risk University, which will become the critical training, retention, and development institution at RSG on the wholesale broker side. And through All Risk University, they've been able to cultivate and recruit folks right out of college and develop them into brokers with 7-figure books. So those are some boxes that were checked by the deal. But also, George, I would be remiss if I didn't, remind our audience, and you hear this anytime you hear people talking about deals, culture is critical to the success of any transaction. And we've known All Risk for quite some time. And Tim Turner would always say, if you walk into a room of All Risk brokers, it felt like you were interacting with brokers at RT Specialty. And that speaks to the similarities that already existed between our firms. I would say that their management philosophy, their growth-oriented focus is a near perfect alignment with ours. And it was really special in this deal to have looked at, to have thought about a company for so long, to have admired them from afar, just to get up close and realize that the management team and the production force is even more impressive, even better than you thought, is really, really special and not something that happens very often.
Totally agree with those thoughts and some great color. When we look at the marketplace, the organic growth capabilities is somewhat very elusive in many situations, and having a firm with that capability, I'm sure, was very much appreciated and valued, and no pun intended on the valued component there. So
no doubt.
When you look at the M&A environment, we see a lot of private equity involved in the sector, and Ryan Specialty Group themselves took on a minority position last year. Maybe if you could talk a little bit about how your private equity partner influenced the transaction and or the process, and how that's going to be leveraged in a going forward basis.
Yep. So the equity partner that we took on, it was actually in 2018. It's crazy that that's 2 years ago now. But so you're referring to Onyx. The strategy that I just outlined, the perspective we have on M&A was really a meeting of the minds that Pat and Tim had when they basically founded the company 10 years ago. And we really haven't deviated from that. I think when we articulated that 2 years ago, it resonated with Onyx. They're, as you know, extremely savvy investors in the insurance and insurance distribution space. And I think they really appreciated, one of the things that drew them to us was, our conviction that we're not just buying growth. We're not doing deals strictly for scale. So, and our relationship, our familiarity with All Risk actually predated our relationship with Onyx. So they weren't a driver in the strategy that led us there, or they didn't physically, make the introduction of anything like that. And I would say, they're a super partner in that they don't really try to meddle too much. I would actually say a hallmark of our relationship, and one thing we did our best to diligence when we were taking them on as a partner, and we actually checked references to verify this, is, when you need help, when you need advice, they will instantly bring world-class resources, world-class people to the forefront and, bring them to our disposal, which we've taken them up on a couple times. But if you're not raising your hand, they're not trying to tell us how to do our jobs. They're not trying to steer the ship. They're really support when you need them, and they don't meddle when you don't. So we're really, really happy about that. And, while they didn't drive us to the all risk deal, they were incredibly supportive. They saw the value of it. And in terms of, my job, because we were out raising capital in what was a pretty difficult debt capital markets, during the period that we were doing diligence and trying to consummate the transaction, they were with us every step of the way on diligence, a second set of eyes, and a different perspective. And they were really, really handy navigating the choppy debt waters. So we're incredibly thrilled to have them. And, they're not beating us up to do huge deals, more deals. Like, they're incredibly patient capital. They actually said this in their press release. They're invested in us through the balance sheet of Onyx Corp. So not one of the funds. So they have the ability to be even more long-term and more patient. And while they're not pressuring us in any way to do deals, they know that M&A will always be a part of our long-term strategy, and they're there to support us every step of the way.
Got it. Well, you mentioned how huge of a deal All Risk was, and absolutely that was the case. How does that influence your acquisition activity going forward, assuming you find the right partner when in your conversations?
Very fair question. So the deal, you can cut All Risk a couple different ways, but by all accounts, it adds up to, whether it's people-wise, office-wise, even, certain cuts of revenue, it's like adding a quarter of our business. So that's, it's a huge investment. It's a lot of people, and it's just a lot of work. So right now we are laser focused on integration. We want to make sure that we, do no harm in terms of, capturing, harnessing, facilitating the organic growth that they've enjoyed prior to the acquisition. We don't want to slow that down. We want to enhance that. And you have to be very, very deliberate when you're organizing and integrating teams and front office systems and all that. So we have a healthy appreciation for that amount of work. We've done enough. We've done over 40 deals in our time, and the whole organization has their individual pieces down. I would consider us a pretty well-oiled integration machine, but we've never taken on anything of this scale. So I would say that for the next, call it 6 to 9 months, just for safety's sake, the better part of 2021 will be very focused on that. And quite frankly, deleveraging. We're very modestly levered relative to our peers, especially peers that are sponsor backed. We do have a little bit more conservative financial risk management policy. So we are focused on getting back down to more historical levels of debt and leverage. So the two of those efforts combined, George, I would say will take up the majority of our time next year. And we're always, the M&A desk, the M&A machine is never turned off. We're always looking, we're always interested in exploring and having conversations, but in fairness, the bar is, for the next deal is quite a bit higher just because so much of the organization's attention is needed for those mission critical 2021 tasks.
I can only imagine, Jeremiah. Again, I want to say thank you and congratulations on what is probably the most significant distributor transaction of 2020. And I can only imagine what you had to do to get it to completion. So way to go. Well, and thank you to our viewers. We appreciate the time today. And if there's anyone out there that has any questions on what we're seeing in the M&A marketplace, feel free to reach out. Until then, have a great day, and we'll talk soon.